Hello folks, Steve Lentz here with Discover Options. Welcome to this edition of several market timing reports for advanced options traders. This will be for Friday, September 15th, getting ready for the Monday's open on the 18th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So we have three reports for you today. First, the Condor Butterfly Timing Report that answers the question, is now a good time to initiate a butterfly or condor campaign? The second report is the Bull Put Spread Timing Report. This answers the question, is now a good time to initiate a bull put spread in the SPX or the SPY with the short puts located a standard deviation away out of the money, roughly 30 days out, is now a good time. Finally, we have the Directional Likelihood Report for the S&P 500. This answers the question, based upon past occurrences of the current market condition, where is the market likely to go? Up, down, or wobble around for a bit? And so that's a very statistically oriented report, and we'll get to that as well. Before we do all that, I would encourage you to please subscribe by clicking the button and subscribing to our channel and getting alerted when we come out with new videos. Also, for those of you new, we have a nice ebook for you, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. On to the current market condition in the S&P 500. We had an outside bar on Thursday, just barely. The high on Thursday was just barely higher than Wednesday. You can hardly tell from the actual bar there, but it is true. It was an outside bar, followed by an upswing bar with higher high and higher low on Friday. Okay, so that's the price action that occurred. This all occurred when we're way above the 50-day simple moving average. And then in terms of the 15-3 stochastic, we're between 60 and 100 there. And it's just barely underneath the 3-day moving average, the percent D. Okay, that is a market condition that is very unique, given the price action is kind of, very unique. All while that occurred while the stochastic is downtrending and we're above the simple moving average. That doesn't happen that often. Just 29 non-consecutive times. Okay, just 29 times since January of 2000. Not very often. So these reports are based upon a low number of occurrences in past, with our current market condition in the past. So just bear that in mind. Let's go to the Condor Butterfly Timing Report. So since January of 2000, we've had well over 4,400 closes of the SPX. Of these, 65.8% have been favorable bars for selling premium where the actual 21-bar movement in the future was less than that which was predicted by the skew-adjusted VIX, the implied volatility of the option prices. Okay, so 65.8 is the benchmark. Now, we had 29 occurrences of our current market condition. Of those, 75.8% were favorable in that same kind of fashion. 75.8 versus the benchmark of 65.8. We then have a theoretical edge here, a selling edge of 10%. So statistically, it's more likely than normal that the current market condition will end up being a favorable one for market neutral option premium selling. Okay, that's the Condor Butterfly Timing Report. A reported edge. Keep in mind, though, the very low number of occurrences, though. Bull put spreads. This is for those of you that like to lean your strategies bullish. And good case for doing that, of course. And this predicates itself on you selling premium about 30 days out, a standard deviation out of the money in the puts. Is now a good time to do that? Let's take a look. So we've had over 4,400 closes of the SPX since Jan of 2000. Of those, 83% have been favorable bars, such that for selling that out of the money put premium, where the actual 21-bar downside movement was less than that which was predicted by the skew-adjusted VIX. Okay, so you could flip a coin, and basically 83% of the time the market would not move down that far and touch that particular level. 83% of the time you can flip a coin, and that's what you get. Now, During that time, we've had 29 occurrences of our current condition. Of those 29 occurrences, 86.1 were similarly favorable for selling that out-of-the-money put premium. That's about 3.1% difference in terms of an edge, a positive edge in selling out-of-the-money put premium. Okay, so statistically, it's slightly more likely than normal that Friday's bar will end up being one that's favorable for selling that out-of-the-money put premium. Okay, so that's where the bull put spread timing report is at. The market likelihood report. Again, we're answering the question based upon past occurrences of our current market condition. Is now a good time, or no, excuse me, where is the market likely to go, up, down, or wobble around for a bit? So to answer that question, we have to determine price distribution. Price distribution when a certain market condition occurs. To do that, what I've come up with are price distribution bands. Distribution bands, these are set a standard deviation away from any given day's close, a standard deviation up and down 5, 10, and 15 days out. Now I'm using, in this case, I'm using the skew adjusted VIX to determine the distance of these bands from the close. Okay, and let me just show you a little example of this. Here are bars set 5 days from the close. 5 days from the close. So this is the one that's to the upside. These are the 5-day band. This is the 5-day band set to the downside. Now notice that the bands on the upside are closer to the close than the ones in the downside. And that's because of the skew adjusted VIX aspect of this. Because the out of the money calls have a lower implied volatility than the out of the money puts. All right. So that's why you see the more distant lower band set 5 days out. Now here's the question. For this particular close, in the subsequent 5 days, will price go up and hit the upper band, the lower band, or wobble around and hit neither of them? Okay, and we're going to keep the statistic on that particular close. In fact, we're going to go back over 4,400 closes and see what happened in terms of not only this 5-day band, but the 10-day band and the 15-day band. All right, so here are the statistics. We go to the report, we go to the very top, and we can see over the course of 4,471 closes, the upper 5-day band was struck 21.3% of the time, the upper 10-day band 15.8%, upper 15, 14.7%, the lower band 16.6%, 16.8%, the lower 15-day band was struck 19.6% of the time. Now, we have 30 occurrences of our market condition going in the past. Of those 30 occurrences, the upper 5-day band was struck 13.3% of the time. Okay, now that's less than the benchmark up here of 21.3. That's why we have a red number here. Price struck that 5-day band less often by a substantial amount. It struck the upper 10-day band significantly less often. Upper 15-day band significantly less often. Look at that. The lower bands were struck less often across the board. This is a picture of lower market volatility going in both directions. Okay, now, what I like to do is also look at what happens if price ascends above the previous day's high. In this case, Friday's high. Now, when you go back and look at these 30 occurrences, that occurred 11 times of those 30. Okay, 11 times of those 30. Of those 11, when it went above that high, well, you have the upper 5 and 10-day bands getting struck a little bit more often. Okay, and the lower bands, look at that, the lower 5 and the upper 15 got struck 0%. Very interesting. Here we're having some volatile scores because we have that such a low, a low number of occurrences here. Also, I think too, and you could look at now also when price strikes goes down below the low of Friday, that occurred 14 times. But here's the thing: you have 30. This occurs 11. That occurs 14. What happened to the other 15? Right? Shouldn't these both add up to 15? Well, no. That tells me that you had quite a few inside bars where neither the high or the low were struck or exceeded. exceeded. So quite a high number of inside bars occurring on, in this case, it would be Monday. So that kind of, again, throws things out of whack a little bit. But this is the report. All in all, you could look at the 30. I would focus on that and make the conclusion that this market condition is more likely than normal to result in lower market volatility than the market normally experiences. Okay, and I think that's reflected in the edge that we have on those other two reports besides this one. All right, folks, thanks so much for joining us. I'm Steve Lentz with Discover Options. Thanks for joining us. We'll be back next week. Take care. Have a great week. Bye-bye.